I just want to quickly get your thought before we move on to the data on tech, particularly in the US, dominating the rally that we've seen in US equities. Do you want to join that momentum, given that a lot of people do see tech as immune to the economic cycle?
Yes, I mean, we do see the case for tech from a long-term perspective. We think it's a key secular driver. I wouldn't dispute any of that. But, much of that valuation expansion has already taken place. And really, when we're looking at the opportunity set in global equities, at least, we're looking outside of the US primarily. So we're very positive on where we sit today in the UK, in Europe, as well as in emerging markets, as we've discussed earlier. For instance, just looking at valuations in the UK compared to the US, we're at 14 times PE, forward-looking PE here, and we're at 18 times in the US. And one of the main drivers of the recent push up in equities has been, central banks keeping rates ultra low, and that brings down the earnings yield, essentially, and drives up PEs. And when I look at the gap between the earnings yield available in equities and the bond yields, there's more advantage that I see in Europe, in the UK and in Japan, for that to compress further versus the bond yield. So that's really driving our view.
Yeah, I mean, if we get back to the economic data in the US as well, Supriya, so basically we've seen a little bit more optimism. What we saw was from consumer spending driving strong retail sales in December, climbing the most in 5 months. It helped push Bloomberg's weekly index of consumer comfort to a 19-year high. Other reports showed applications for unemployment benefits dropped to a 6-week low, while a regional manufacturing index was the strongest since May. Now, meanwhile, the US Treasury will start issuing 20-year bonds in the first half of this year. That's as the government looks at different ways to fund a ballooning deficit. Ultra-long bonds maturing in 50 or 100 years had also been considered. Treasury Secretary Stephen Mnuchin said in a statement that the government will continue to look into other products to finance debt at the lowest cost over time. Supriya Menon, senior multi-asset strategist for Pictet Asset Management, still with us. So, Supriya, with the Treasury market, generally you're not that positive on government bonds on a valuation basis, and you were just saying how you prefer equities over bonds globally, but you are actually overweight Treasuries. Where along the curve, what's your preference in the Treasuries market?
So we're looking for parts of the world where we still get positive real yields, and that is very much not the case across much of developed markets, with the exception of the US, when I look at major markets where we still see positive real yields. So we have long duration real bonds, basically linkers in the US, and we have that also as a sort of buffer to risks that we have elsewhere in the portfolio. For instance, I've mentioned that we are long sort of cyclical value in the equities portfolio, so we want to reduce risk a little bit through long duration positions, and in this case in US linkers.
Yeah. What's your sort of view of the US consumer at the moment? I mean, we had quite a bit of data yesterday. Retail sales, excluding autos, climbing by the most in 5 months, but also you had Bloomberg's weekly index of consumer comfort that rose, and a gauge of home builder sentiment posting its best back-to-back reading since 1999. Do you have faith in the robustness of the US consumer and how that feeds through to the rest of the US economy?
Yes, absolutely. The U.S. consumer has been deleveraging through this cycle. Wage gains have started to flow through. The unemployment rate is exceptionally low, with lots of, sort of hitherto long-term unemployed being drawn into the market. So the consumer, from a fundamental point of view and from a balance sheet point of view, is in a very strong place. And that sort of means that, they will continue to spend, and the housing market will continue to have tailwinds in the U.S. So we're quite positive on the U.S. consumer. I don't expect that to be the key risk in the near term.
Do you see US exceptionalism fading in 2020? It's a view that PIMCO has, but then Goldman Sachs, on the other hand, sees global growth being led by the US in 2020. I know that you prefer equities outside the US to US equities. Is that based on you thinking that growth in the rest of the world is going to do a little bit better than the US in 2020?
Yes. So if you look at the gap between growth in the US and the rest of the world, we expect that to narrow in 2020. So I'm talking about developed markets here. So the gap between European growth and US growth will narrow, for instance. And if I look at emerging markets versus the US, I expect that to pick up. So emerging markets will grow at a slightly higher pace relative to the US in 2020. So yes, the US is going to continue to be a key driver. You've talked about the consumer pulling in demand from the rest of the world. But it's just, when we're talking about the trough in global economic data, that typically favors the rest of the world versus the US.